In this session, we're going to basically talk about the major questions that someone would face in research, investment banking, or private equity kind of or corporate finance kind of roles in their finals interviews in MBA finance. And how do we kind of approach them or answer them? This does believe that or understand that there's a certain amount of knowledge already available. And we are basically looking at in these kind of interviews, broadly 3 skills get tested. One of them is how can you look and analyze the industry? The second one is how can you look and analyze the company? And the third one is do you understand the valuation angle around it? Right? So basically these 3 skills are paramount in terms of all of these segments. In certain cases, these some of these skills are more required than the others. So for example, if you're looking at private equity, then maybe an understanding of the industry is much more important than the understanding of valuation, because honestly at that point of time, valuation is just a figment of imagination. Right? But if you're looking at maybe equity research kind of a role, then valuation becomes equally important. While industry is important and company is important, valuation is also equally important. At all points of time, a lot of the information about the company could be found using standard financial statement analysis techniques. And when I say standard techniques, that doesn't mean just calculating ratios, but basically digging into the annual reports. And if you can dig into the annual reports well and find out a lot of data from the annual reports, decode data, try and look at ratios and say that, okay, why should a certain ratio, certain company be doing well or not doing well, or why should a certain ratio be going up or going down? If you can try and address this why question, then that is a big start in terms of understanding the company better. So these are common threads that are going to come in the context of all the questions that you're going to see. And then every question is going to address one or the other portion of these broad threads that exist. This is the same with corporate finance interviews as well, which is similar to investment banking, just that investment banking is typically external to a company and corporate finance roles are typically internal to a company. So if you end up in a corp fin role in Aditya Birla Group, you're going to find out where are you going to allocate capital. Would you do it to Hindalco, or would you do it to Idea, or would you do it to Ultratech Cement? Whereas if you're an IB, you're basically making that decision for someone else or helping someone make that decision as an investment banker. So broad skill set is again similar, just that there's more decision making and responsibility power in the case of corporate roles than let's say investment banking roles that are existent. With that, we begin. Please note that this is not an exhaustive list of questions that can be asked. We are trying to cover some major questions and indicate what kind of questions are being asked. So please don't treat by any means that this is your exhaustive list of questions. You can dig deeper and build on these questions as they come along. But broadly, this is a common size denominator of all these interviews that you are probably likely to see in some of these questions, right? So let's start with a very basic understanding of relative valuation, which is when you're trying to compare companies and look at their value as it appears across the markets, right? Remember, relative valuation is always going to be comparative. So in a sense, it believes that you're choosing the relatively undervalued company. You are not going to be able to find absolute valuation here. For absolute valuation, you have to go to DCF. So DCF is basically absolute valuation, where you're trying to find the valuation of a company independently of other companies in the market. In a sense, relative valuation also tells you that you are going to basically pick up one company at any point of time, and that's basically going to be the part of your decision making. It assumes that the market valuation is where it is, and you are going to pick up one between the others that exist there. 3 most commonly used relative valuation metrics are price to earnings ratio, price to book ratio, and enterprise value to EBITDA ratio. Right, now let's quickly understand these 3. We will spend much more time at price to earnings as we go along, because that's the simplest and yet most misunderstood and easiest ratio to kind of misapply and incorrectly apply in the context of things that we're looking at. But broadly, what you understand from price to earnings is if a company has earnings of 10 and the price is 200, then you're paying 20 rupees for this 1 rupee worth of earning. And all other things being equal, if there's another company whose earnings are 10 and the price is 300 for that share, you're paying 30 rupees for this. So everything else being the same, you would want to pick up the one with the lower price to earnings ratio, right? That's the theory, and that's broadly where the theory ends, right? Real life, obviously, it's very difficult to find two companies that are extremely similar. In fact, the closest you can probably think, or the first example that will come to your mind, would be in TCS and Infi. And in this case, TCS is 1.5 times Infi. So in a sense, there is no real comparable that is available when you're comparing companies. Consequently, PE ratio is a little bit tricky because it appears to be simple, but it is not so simple when you're applying at companies. The context of PE we'll try and decode as we go along. The second ratio that comes handy is something called as price to book ratio. Now, within relative valuation, price to book ratio is a ratio that can be used both as an absolute metric and as a relative metric. Now, in certain sectors, relative metric works. In certain sectors, it does not work well as a relative metric. It works only as an absolute metric. Let's understand. What is the book value of a company, of the equity of a company? Book value is nothing but share capital plus reserves and surplus, right? So the sum of these two is going to give me the net worth or the book value of the company, or the book value of the equity of the company. What are reserves? Reserves are all undistributed profits till date. So basically, if you're standing here in 2018, then all the profits that the company has kind of earned but not distributed in the history is book value, right? This is basically if the company closes today, sells all the assets, right? You sell assets, then you kind of pay your liabilities, external liabilities, and then what is left is basically for the shareholders. That's called the book value. So in a sense, if the balance sheet is correctly reflecting the state of affairs, if you are going to kind of sell the company today, it should be the minimum value that you're going to get out of it. Why the minimum value? Because the market value of the company, on the other hand, is not just this. The market value looks at history and also looks at future. So that's my market value. Or in other words, market value of equity is going to be my market capitalization, right? Now, in most cases, market cap has to be greater than book value because you assume that the company will have a positive future. If this relationship does not hold, then theoretically the company has negative future. You should close the company down. So let's assume the company has a book value of 1,000 crore and market cap of 700 crore. You should immediately do 3 steps. Buy the company, close it down, sell all the assets, buy the company and close it down. So that's 1. Sell assets and pay liabilities. So when you sell assets and pay the liabilities, you're likely to kind of see the 1,000 value recovered. So invest 700, buy the company, close it down, sell all the assets, and then recover 1,000. So that's an arbitrage that is available. Because arbitrage is not available, you will rarely find this scenario where price to book is less than 1. And I'll tell you the scenarios where it could be less than 1. Now, the only reason why you could have a scenario where price to book ratio or market is less than 1 or market cap is less than book value is if you cannot close down the business, right? If I can't close down the business, when would that happen? Take the example of a company like MTNL, right? Government entity, loss making. Can you close down the business? Even if you buy the stake, you'll not be able to buy it completely. Even if you kind of try and have a substantial stake, it's unlikely that you will be able to close it down. And it is loss making. So it's going to keep making losses in the future. Future is negative. Reserves will keep falling each year because of those losses. So the current market value is actually reflecting a bleak future and the inability of the company to close it down. So basically, in isolation, if you believe that the future of the company is positive, then your market cap has to be greater than the book value because it's basically book value plus a positive number or a non-negative number, right? And so consequently, price to book should always be greater than 1 unless this condition of trying to buy the company and close it down cannot be fulfilled, which is typically going to happen with most PSU entities or entities where you have large conglomerate interest and the conglomerate is not willing to basically close down the business, right? Because they just like kind of running the business as you go along. So that's an important contour of understanding price to book metric. Now, where is price to book used? It becomes difficult to use it honestly as a relative metric because it depends on the book value, and book value is typically historical in nature. So if a company started in 1980 and another started in 2010 and their operations are exactly the same, you might still find a difference between the book value of A and book value of B. So it's strictly not easy to compare these unless they've chosen to revalue all the assets. The only sector where you can use this correctly as a relative valuation metric is basically your banking sector, right? Why do you use it in banking? So there are two logics around it. One, basically in the banking sector, all your assets and liabilities are financial in nature. Because they are financial in nature, you kind of mark them to market. They are not historical cost. So the concept of historical cost does not apply there in the context of banking or NBFC sector. So you don't have that problem. When you are valuing one bank versus the other bank and comparing them on price to book, you typically have an exact estimate of what their book value is, and that's live in terms of the market value. And that's why price to book is a common ratio that is used in the banking and NBFC or non-banking financial companies segment. The other reason you use it is because in banking, earnings tend to get distorted, right? Why? Because when you get your earnings before tax, right, from there you cut down something called as provisions to get to your final number, and you get your profit after tax beyond that once you've paid tax on it. So essentially, if you increase the provisions, your PAT will go down. If you decrease the provisions, your PAT will go up. In fact, if you look at the recently announced results of Bank of India, right, this is a result of Q1 financial year 2019, you will note that provisions have gone down, and so consequently PAT is higher than estimate. When you look at the number of PAT, it's slightly higher than the estimate that the market was putting in because provisions was lower. And so in that contour, the reaction of the stock market may not be as positive because obviously there's a nitty-gritty around this entire provision number. Also, earnings tends to get distorted. So if you look at the numbers of, let's say, Bank A and Bank B, and Bank A is a safe bank and Bank B is a risky bank, then in all likelihood, the provisions here will be higher and provisions here will be lower, which will mean earnings here will be lower and earnings here will be higher. All other things being equal, if you were to calculate price to earnings here and price to earnings here, price to earnings here, because earnings are high, the overall ratio is low. And because earnings are low, the overall ratio is high, you will end up choosing the risky bank if you use price to earnings. And so consequently, for the banking segment, anything that can distort the earnings do get distorted. So you tend to use price to book ratio more often, purely because the other challenges of using this as a relative valuation metric do not exist. So that's why you use price to book for the banking segment. Very common question in a lot of the interviews that you're going to get. Right. Next, you look at this third metric called enterprise value to EBITDA. Now, earnings also get distorted in certain other sectors where from EBITDA, if you're going down and you have a huge depreciation and you have a huge interest and kind of tax is kind of constant, so the PAT goes down even though EBITDA might be high. If these numbers are large, that basically tells you it's a capital intensive industry. Right? That's why interest is high because the company runs a lot of loan, and depreciation is high because the company runs a lot of fixed assets as well. In this particular case, the earnings again get distorted, at least in the initial few years you're running the business. Why? Because obviously depreciation and interest are large components. And so it may be a better idea to use EBITDA as a metric. Now I can use either price to EBITDA per share, but that metric becomes inconsistent. Rather than earnings per share, I could use this. Why is this inconsistent? Is because EBITDA is for both the debt and equity guys. So the numerator also has to become a debt and equity measure and not just the price, which is an equity measure. So what is the debt and equity measure is something called as enterprise value. What do we mean by enterprise value? Enterprise value is nothing but the market cap of the company, market capitalization of the company, plus debt minus cash. If you think about it, you're buying a company that has 1000 crore of market cap, 1000 crore of debt, and 200 crore of cash. You will need 1800 crore to buy this company because you will get that 200 crore back. That's your own money. And that in a way is already reflected in the market cap because that's public money and publicly displayed money, and you know that it is there on the balance sheet. So the market cap should account for it already, right? Now, when you use this metric, you basically create something called as enterprise value. You divide this by EBITDA. Now, both your numerator is equity plus debt and your denominator is equity plus debt becomes a consistent metric. The price to earnings ratio can also be written as market cap divided by net profit, right? If I use the price and I use the EPS and multiply both of them with number of shares on the numerator and number of shares on the denominator, that's going to give me market cap by net profit. This is a measure that's equity by equity. EV by EBITDA is used in all capital intensive segments. So if you look at sectors like metals, if you look at sectors like infra, if you look at sectors like oil and gas, if you look at sectors like telecom, in all these segments where you need a lot of capital expenditure happening, that is where basically enterprise value to EBITDA is the metric that you're going to use. So all those sectors, the better metric to use in enterprise value to EBITDA. That's the next bit that you understand about relative valuations and how you kind of go and look at it. Now, moving ahead to DCF, DCF is a simple concept. You're basically going to use cash flows of multiple years, going all the way up to the last year and then up to the infinity. And you're going to discount all those cash flows at a certain expected rate of return. That rate of return could be based on a certain estimate, which is called as weighted average cost of capital. I'm sure all of us have read it. This is nothing but cost of equity into weight of equity plus cost of debt into weight of debt into 1 minus the tax rate, right? And in case your cash flow is for only the equity holders, then you use something known as only the cost of equity, which is derived by the CAPM model, risk-free rate plus beta into RM minus RF, correct? That's broadly the contour of things that are there. So broadly, DCF is something all of us know how that gets done. We are not going to get into the nitty-gritties of DCF other than a few things that are important for us to understand around DCF. Point one, it's imperative. DCF has three kinds of models: dividend discount model, free cash flow to equity, and free cash flow to firm. Let's start with the first one. If you buy a share, the only possible cash flow to you is dividends, right? So technically you should only do dividend discount model. But the problem is if the company gives zero dividend, that does not mean the value is zero. A high growth company is likely to give zero dividend or very low dividend because they are reinvesting. And in this particular case, if you try and discount dividends, the value is going to be close to zero. So not used. Broadly not used in any kind of industries in a country like India, right? Then you move to something like FCFE, which is nothing but a proxy for dividend. So you are finding out essentially what is the capacity of the company to pay as dividend. And then you assume that that entire dividend is paid out, right? So rather than waiting for the company to pay dividend, you are saying what can the company pay as dividend and put that here. The third one is something called as free cash flow to firm. So all cash flows to the firm holders. Now, in this case, you are again going to look typically at equity plus debt holders. So when you do FCFE, that's very similar to your cash flow creation that you do in the balance sheet P&L cash flow, with the sole exception being any adjustment to equities like dividend, etc., don't get accounted in FCFE. But in FCFF, any transaction that happens between equity and debt also get cancelled because then both of them are part of the firm. If debt gives money to equity, that's a part of FCFE. In FCFE, you do account for a line item that's called change in debt. But in FCFF, you have to remove it because that's like one hand giving the money to the other hand in the particular company, right? So that's FCFE and FCFF. And then you can go around trying to value this as you go along. There are some common issues when you try and calculate the DCF value, right? So let's look at those. Now, you see errors that are going to come in that you will typically see. One is terminal value is more than 50% of the present value of cash flows. So when you build a cash flow, you're going to look at cash flow 1, cash flow 2, and so on and so forth till your explicit period, which usually is 5 to 6 years. And after this, you use a concept called terminal value calculation, where you apply certain sort of formula that the company is going to grow at a growth rate G and is going to grow till infinity at that particular growth rate. Essentially, assuming that the company is going to be at a self-sustaining growth rate or a steady growth rate at that point of time till infinity. The solution of this is like a geometric progression. We'll not touch that upon here, but broadly what you find is that the value of all the cash flows beyond this point are attributed in what is called as the terminal value. Now, the way you calculate or approximate this terminal value is you take the last year cash flow, which in our case is going to be CF5, you multiply it with the growth rate and you divide it by R minus G, R being the cost at which you are discounting the cash flows. So this number basically depends on just one number, which is the growth number. And if you're wrong in this number, it can basically change the value of the company completely. So whenever you're valuing, and if you get the value of the company as 100, do remember that your explicit cash flows, which is this set of projections that you're doing explicitly, need to be at least 50%. If you see a scenario where these cash flows account for 30 rupees and the final cash flow accounts for 70 rupees, then 70% of the value on the model depends on just one number, which is the growth number. And if that number changes, then things go for a toss. So one of the most common errors that people do is you don't check for what is the terminal value and what is the total value. And if that is not working, then you can't apply terminal value here. You have to project for more years, or you have to make an assumption that tackles that. Right? The second is we typically use this entire concept of historical growth rates forming future projections. So if Maruti has been growing at 15% in last 5 years, then we will assume a 15% growth in the next 3 years as well. As good as bad, purely because by that logic, no company will ever grow faster than what they are doing or slower than what they are doing. And this is just Excel jugglery. It doesn't show any kind of understanding of the business or interest, right? Treatment of cash. Now think about it. If a company holds cash, like let's say in fee, right? If you look at cash, the cash is going to generate other income, which is going to form a part of your cash flow. And then you're going to discount this cash flow at a certain rate R, right? R signifies the cost of equity of Infosys, which is the overall risk of Infosys. But cash is a riskless asset, right? Other assets of Infosys may not be riskless, but cash is riskless. It has to be perceived as riskless. So you are taking earnings from a riskless asset and discounting them at a risky rate. That doesn't make sense, right? So logically, when you're looking at earnings as from a riskless asset, this amount has to be discounted as a risk-free rate. So the best solution is to just ignore the cash in the model. Don't assume any cash. And then once you find the equity value, add cash to it. That's usually the value you will do. Otherwise, you will make a mistake of sort of undervaluing the company, right? The final common mistake that we see usually is when you get a model that you're working on, the cost of debt sometimes gets calculated to be higher than the cost of equity. That is never possible. Mathematically, you could get a beta value that gives you a cost of equity which is lesser than the cost of debt, but that is that's to be discounted. That you don't take that beta value. You have to ignore that beta value and move ahead and look at another cost of equity calculation method. So never ever will cost of debt be greater than cost of equity, because debt is less risky than equity. So the cost of debt has to be lesser than cost of equity all points of time. You could get negative beta as well sometimes, statistically speaking. That doesn't make sense, because if you have negative beta, then the company would appear to be less risky with respect to risk-free rate, and that doesn't make sense either, right? So these are some of the common errors. When you build a model, someone opens the model, they're going to see and ask questions on this. If you are ever asked to kind of build a model in a particular exercise, in some competition or in some project or in some sort of a interview that you see, right? The most common question that you're going to get across these interviews, and this is the best one to impress if you want to kind of nail the interview there and then, if you do it properly, of course, is pitch any company or stock of your choice. How do you analyze a business if it is a private equity interview? Or tell me about a company that you admire and what makes it attractive. Now, think about it very clearly. When you are evaluating a company, there are three broad prospects once again. You have to evaluate the industry and have sense about how the industry is going to grow. Sometimes people will ask you questions about what do you think is the total number of jeans sold in India, right? Or what is the per capita jeans consumption in denim consumption in India? The whole idea is the contour that they don't want you to give an exact answer. They're just looking for an approach on how do you try and ascertain the size of the industry. So if you have a sense of one of these industries, so let's say if you have analyzed the footwear industry sometime and you know that the sort of penetration in India is 2 pairs per capita, right? So India's population is 125 crore. Total number of footwear sold in India every year is 250 crore pairs. That's actual number exactly. So you're getting at a 2 pairs per capita. So you know that denim cannot be too different. It's probably going to be lesser because your value of denim is going to be much higher than footwear in general, right? So consequently, on average, right? So consequently, the penetration has to be less than 2 jeans or 2 pairs of jeans per capita. If someone throws a number to you that denim penetration is 5 or 4, you should be able to kind of identify that. So it's important for us to have a sense of the industry. That's one. Two, you need to have a sense on the company. Now, again, when you have a sense on the company, it boils down to FSA. It boils down to understanding the management actions as well. So not just FSA, but management actions, and a lot of it is corporate finance, right? So things that are not really easily available. If you go and look at certain companies where profits are falling, but the management is increasing their own salary or compensation. Data is available in the annual report if you try and dig deeper into that. If you look at action of management where a company is basically borrowing debt and then giving dividends out of it, that doesn't make sense, right? But companies kind of play out. So that is where you are basically looking at data that is playing out. 2 pairs per capita would mean 2 pairs per person. So on average, every person in India has 2 pairs of shoes. That's an average number, of course. Averages are misleading, but the broad penetration is 250 crore pairs of footwear get sold every year, and 125 crore odd is the population of India, right? And finally, you have to talk about the value that is on the table. So value could be in terms of the PE ratio, value could be in terms of DCF that you know, value could be just in terms of the current size of the company versus the opportunity size that exists, right? So let's take a look at this quickly. One of the examples is, for example, Eicher Motors. Now think about it, 2010, what you see in red here is the annual volume of Royal Enfield motorcycles. India's market for premium bikes was about 50,000 bikes a year in 2010. Now, if you just think about it, it doesn't make sense that a country as large as India could have a 50,000 bikes per year kind of a market. This market has gone from 50,000 bikes a year to now 70,000 bikes a month. And here, Royal Enfield had a 95% market share, and here they have a 95% market share. So there is no other player who has walked in. So the first understanding is the industry itself, which is as affordability increases, this kind of penetration level is not going to stick. It is going to be a big demand that is going to come in, right? The second part is the management part about it, which is there is this company that has 95% stake in a growing market. The market grows at a breakneck speed. So the volumes now, they used to sell 50,000 a year. They now sell 8.5 lakhs a year. That's a 17 times jump in the volume over an 8-year period. and the price of the bike has gone up 100% in this period. It's doubled basically on average, right? And they still hold 95% market share when they had 95% market share here. So there is this management which has not only captured the industry growth, has increased its capacity exactly at the same pace as the industry has grown. They could easily have said, we are happy with 3 lakhs of capacity and we are selling it to full capacity. But they knew when to increase, they knew when to hit the nail on its head, and they kept doing it, and relentlessly. Operating margins of the company, EBITDA margin of the company used to be about 15% here. It's at 32% now. This is unheard of in the two-wheeler industry anywhere in the world, right? So this kind of a remarkable performance is what this company comes in with. So you have a good attractive industry where penetration level is low. You have a good company whose financial statements will show less debt, and management actions will show that they are kind of in line with good coherent growth strategies. And finally, you look at value, which is the most tricky part because it is extremely difficult to project this kind of growth. Now think about this. What you see there is the volume growth number on the screen, right? If I take historical averages of these 4 years and maybe this 5th year, I'll probably work around a 15% number. Look at the growth rate over the next few years in volumes, right? So remember, life is non-linear. And when you use historical growth assumptions, if we were building a model here, none of us could have predicted what is going to follow. All of us would have failed in this. And that is exactly what is the difference between a good analyst who can see the industry a little bit further and say that, look, 15% is history. You could have 50% next year. Just because affordability increases. What is stopping Indians, for example, from traveling abroad, right? Can that number grow at 50% next year? It can. It just probably is a matter of time. At some point, suddenly the number of people traveling outside India is going to increase dramatically. This is basically a sense of industry and growth that you need to build into the table. Remember, no model is foolproof, so you can be wrong in the model, but it's important to have a sense of where we are. 50,000 bikes is a meaningless number to have in a country as large as India. And just to give you an idea, at this point of time, total two-wheeler sales in India were about 1.25 crore. 50,000 is what premium bikes had. Right now it's about 2 crore. It's still a more respectable ratio of about 9 lakhs right now. So that's about a 4.5% of your total market going to a premium bike segment. Now, this is essentially what you would want to kind of build into your understanding of any one sector. You don't need to do it on multiple sectors because the question is open-ended. The question says pitch any stock or pitch any sector or any business. They are just they're trying to see whether you have a complete coherent understanding of not just the company, but the business environment and about the value. And so that entire chain has to be fulfilled. And the first part of it is extremely important. The industry part is extremely important if you ever enter an IB or a PE interview. The valuation part is very important and FSA part is very important if you're looking at an equity research or a corporate fin kind of an interview, typically, right? So that's about this one. Now let's look at very quick understanding of PE because I said that PE has to be kind of looked at in a little bit more detail. Think about it. Is a PE of more than 50 expensive or a PE of less than 20 cheap? This is the single most important mistake that most analysts or investors end up making about the PE ratio. These are the PE ratios of some of the companies, slightly dated, a little bit old, but there's a very clear trend that you see here, and I'll explain this trend in a minute. Let's first understand what does PE mean once again. So when you look at earnings, let's say earnings is 10, right? And you're paying 200 for it. Let's assume the growth of the company is 0%. So it means it's going to give 10 next year and 10 next year and 10 next year, which broadly means your 200 rupees is going to get recovered in 20 years. So in a sense, if the company is not growing, PE is the number of years in which you will receive your money back, right? So here you are willing to give your money to Britannia for 61 years, but to NTPC for 13 years if they stop growing right now. That's basically what this number means, right? That's one. The second part is there's another company that grows now, right? So the EPS keeps increasing. In this case, you're going to get your money back faster. So you'll be willing to pay more because you're getting more money faster, right? So there are two factors that will impact PE. One is stability of the business. The second is growth possibility in the business, right? These are the two major drivers that are there. And now if you look at this segment and you basically divide this here, I've just taken a broad selection. Everything on the above is not only stable, it is also growing at least a steady pace. So either extremely stable or very high growth or a combination of these two. Everything below this, there are problems in terms of stability or there are problems in terms of growth because either they've become too large or just a volatile industry. So metal companies, volatile industry, mining companies, volatile, oil companies, volatile, power, extremely capital intensive, power capital intensive. Infi TCS not growing as fast because they're large, right? And kind of affected by global dynamics on the IT industry. HUL, Britannia, they'll keep selling toothpaste, they'll keep selling soaps, they'll keep selling biscuits, whatever the case may be, for the times to come. There is no let up in that demand that's going to happen given the way we are at the industry, right? Avenue Supermarts, DMart essentially trades at some crazy valuations at this point of time. But who are we to say if it is crazy after all? I mean, how do we define craziness in a particular valuation multiple? Eventually, DMart, if you look at DMart's dynamics, right? So if you give 1 square foot of space to a Reliance Retail, a Future Retail, and DMart, then in 1 year, Reliance sells 9,000 rupees on that 1 square foot. Future Retail sells about 9,000 crore on that square foot. DMart sells 32,000 crore on that square foot. 32,000 on that square foot, right? Rupees, sorry. 9,000, 9,000 and 32,000 per square foot. So just sheer efficiency is remarkably high. DMart is present in about 2 broad states at this point of time, Gujarat and Maharashtra. Every other state, they have meager presence, right? Total number of stores is about 130 to 140. Whereas in India, you could easily have a 1,000 store company playing fairly fine, right? Profitable. None of the other companies are profitable. They make a profit. They are extremely fast growing. Last 5 years or last 6 years growth is greater than 40% each year. So you are basically paying for this huge growth opportunity, huge opportunity that exists, the fact that they know how to run the business profitably, and the fact that retail is an extremely stable business and you're paying 120 for it. And is that expensive? Should you not buy it? So the stock is at 1500, and let's take for argument's sake the EPS is something like, let's say 12 rupees or 10 rupees, right? Let's put it at 150, right? If it is growing at 50%, then next year it'll be at 15. The year after that will be 22, 33 and 50. So in 4 years, it should be trading at 50 rupees EPS. It should be giving 50 EPS, right? And let's assume even if the price is 50 times of earnings, so PE ratio is 50, you will multiply these two to get the market price. You still don't lose money even if you buy at a PE of 150, right? So a lot of the people are looking at PE in a slightly different sense, which is certain sectors get a higher PE ratio. And so you don't answer the question on PE in India saying that PE of a particular company is high or low. You have to try and answer, why does it get that valuation? Why does Britannia get 60 and why doesn't Tata Steel get anything more than 10 at any given point of time? And when you look at the numbers, when you look at the financials, when you look at the data points, you will realize what is the scene. You look at Hindalco, 1 lakh crore of sales and about 1500 crore of profits. If your sales dips by as much as 2%, you are in losses, correct? And they sell aluminium whose price actually can move 2% on a daily basis. Why will you give time to this company? Why will you give money to this company for 50 years? You cannot, right? Because you don't know if it will survive 50 years. And that is exactly where sectoral valuations change. It is important to understand this perspective of valuation. Another question that you're very, very likely to get asked in the context of your interviews about valuation of some of these companies that is there in the markets, right? So that's broadly it, what we had wanted to kind of cover today.